So let's take it up with Adrian Mowat, who is joining in, is a veteran watcher of emerging markets and, of course, India as well. Adrian, great to have you on the show. There's so much going on, right? There are elections. There's S&P sounding more optimistic on India. Yesterday, we are getting the GDP print. And here is the market, which is practically at all-time highs. How do you feel about India as we get into the big election outcome event next week?
I'm a little bit cautious on India at this point. We've had a very good move over the last couple of years. Valuations were up sort of 23 times forward if you look at the MSCI India level, and that compares to around 10 times forward for MSCI China. And we've had significant outperformance of India versus China, but more recently that's beginning to reverse, and I think that's putting pressure on the international funds, particularly the EM funds, to perhaps adjust those levels. I think the perspective on the election as an event is the expectation that the incumbent government will win a majority. Maybe the size of that majority has been moderating in terms of expectations, but it sort of looks like an event that probably wouldn't generate much upside if the consensus view comes through, and perhaps would have an asymmetric downside if the BJP majority was very narrow, which I think is very unlikely. So I don't see investors looking at the election as something they need to aggressively buy ahead of, if that makes sense. And then when we look through how the market has been performing, you've got a really big spread of returns, and the things that have driven the market, the index, have been relatively narrow, and maybe not some of the traditional stocks that international investors would have held, such as the private sector banks or IT names.
Okay, so you're a bit cautious on the market. Got that, Adrian. It's good to see you after a while. It's been a while since we've chatted. But overall for the market, right, it's quiet, you'd have to say, but the bank nifty is really pulling in the punches right now. 230 points higher on the bank nifty, making its presence felt. And lots of banks actually batting for the bulls, whether it's SBI, which is your top gainer, Kotak Mahindra Bank, ICICI Bank, IndusInd, that whole lot is up in the green. Adrian, I wanted your thoughts on banks, because now we're suddenly seeing some of these underperformers come back into the fray, whether it's something like an HDFC Bank, where there has been large delivery-based buying in the last few days. PSU banks are coming back in a big way. Notwithstanding what happens with the election outcome, do you think for a long-term investor, the time has come to put more money to work in banks?
I think it's still a little bit premature. So if you look at HDFC Bank, it's about 2.4 times tangible book value. Its forward P multiple is significantly lower than it used to be. But on a price to tangible book value, it remains one of the world's more expensive banks. Perhaps you find some of the faster growing Indonesian banks with similar price to tangible book levels. So it superficially looks interesting on a forward PE, but there is still this debate about, India is a place which runs a current account deficit, so it has a savings deficit. Deposits are a key ingredient in the banking industry. And in the past, the private sector banks are incredibly good at accumulating deposits much more rapidly than the broader banking system. That's now not the case. I think they've probably caught the sweet spot in terms of the customers that would move towards them. And we're seeing the PSU banks benefiting from, the significant reform that you had with the bankruptcy code, the recapitalization of these banks. And so this trend of SBI outperforming, which it even seems to be doing today, probably continues versus the traditional blue chip private sector banks that the FIs would hold, such as Kotak or HDFC. So I think it all comes back to this competition for deposits in an economy that's growing rapidly and has good uses for capital. And this issue with availability of deposits is a broader issue for the global banking system. And what we see in places like the United States is people putting money into money market funds rather than leaving on deposits. So I think there's a broad global story here that even the top quality banks with high return on capital employed are struggling a little bit when it comes to deposit growth.
Hi, Adrian. Good morning and good to see you. And Nigel on this side. Yeah, the way SBI has outperformed HDFC Bank in the last year or so has been phenomenal. But we started off this conversation by talking about India as well as China. And in China, there are some various policy measures that are helping them and in turn helping metals as well. How do you approach this entire metal basket? Because in all probability, you'll get a couple of rate cuts. It'll soften the dollar. Demand hopefully comes back. And, some of these metal stocks have already priced in most of that. Your view on them?
Yeah, I think people have got a little bit too optimistic on China's demand for commodities. They are doing policy actions with regards to the property sector. But remember, the big issue in the property sector is vacant properties plus partially finished properties. And as they resolve these issues, which are really issues around the financial system, the banking system, in themselves, I don't see them as being a source of significant demand for commodities. So I still expect things like the iron ore price to remain relatively soft. We have seen some strength in things like copper, but that seems to be partly a function of some supply disruption. We've also broadly, we've had a bit of excitement when it comes to M&A in the metal space with BHP putting in a bid for Anglos, although that now seems to have been withdrawn. So that'll be interesting, that dynamic. So I would caution people that are thinking about buying more into the commodity space. I'd be more on the camp that you should be reducing after making some pretty decent year-to-date profits.
Okay, it's a little cautious on metals and on commodities. Adrian, let me just pull out for the bigger picture again. I mean, speaking of China, this year started off with the hope that foreign investors will double down on India because, they didn't do much for the bulk of last year. But that has not played out. I mean, in equities, foreign investors have pulled out close to 20,000 crores of Indian rupees. They've pumped in a lot more money, double that amount in bonds, actually, Indian bonds, ahead of the JP Morgan index inclusion. Earlier, it was about Japan. That was a hot market. Now, what is it? I mean, what do you think is behind this disenchantment that foreign investors seem to be having with India?
So I wouldn't say it's a disenchantment specifically with India. The emerging markets as an asset class have been extremely disappointing. And a lot of that has been due to the weakness in China. But we've also had significant weakness in markets like Brazil, South Africa, which also has elections at the moment, has been very disappointing. That's all going on while the S&P and NASDAQ have continued to make new highs. And I think what we've seen is this global equity money moving out of emerging markets. And India, unfortunately, suffers from that move, even though India's fundamentals are much stronger than the balance of emerging markets.
And do you see that reversing? That's the point, because US markets up until very recently, I mean, look at Nvidia, look at the way the market's moving. So do you see this trade continuing because some other markets just doing so well, or do you see a reversal at all in the second half?
See, I do think there's going to be a reversal, and I'll go back to talking a bit about what's happened in China. So if you look at the large cap names in China in the index, these all tend to be in the tech enabled spaces. So you've got gaming companies like Tencent, you've got the e-commerce names like Alibaba, JD. These companies are announcing significant increases in dividends and big share buybacks. And it reminds me a little bit of the tech names in late 22. Remember, NASDAQ had a terrible 2022. You had significant declines in the major tech names, stocks like Meta being at record low valuations. And in response to this, you got a real focus from the board of directors on shareholder value. And that was the start of the recovery in NASDAQ. I think we're seeing some evidence of that in the big Chinese names. And although we talk a lot about Chinese property stocks and banks, they're a very, very small part of that benchmark. So if you've got these large cap tech names, which tend to have quite a lot of cash on their balance sheet and are more focused on reducing costs and generating more free cash flow, they start to look like attractive financial instruments and can be sufficient to drive the China index higher.
Okay, Adrian, we'll leave it at that. Thanks a lot for joining in. Appreciate your time here on CNBC TV 18.